In today's video, we'll be diving into one of the most dramatic financial crises of the late 20th century, the Russian financial crisis of 1998. This crisis was a turning point for Russia's transition from a command economy to a market-based one. It caused widespread economic turmoil and had ripple effects that impacted global markets. So, what led to the collapse of Russia's economy in 1998, and what were its long-term consequences? Let's find out. The economic landscape before the crisis. After the collapse of the Soviet Union in 1991, Russia faced a difficult transition to a market economy. During the 1990s, the country went through privatization efforts that allowed state-owned industries to be sold off to private investors, creating a new class of wealthy individuals called the oligarchs. However, this transition was rocky. Russia faced hyperinflation, a steep decline in industrial output, and a lack of institutional and financial stability. Although the country was rich in natural resources, especially oil and gas, it had trouble managing these resources in a way that would benefit its population. The Russian ruble lost significant value during this time, causing financial hardships for many Russians. Key factors leading to the crisis. The Russian financial crisis of 1998 didn't happen overnight. Several key factors contributed to the crisis, including, by 1998, the Russian government was deeply in debt, owing billions of dollars to international creditors. Much of this debt was short-term, and the government had to constantly borrow more to service its existing debt. Russia's economy was heavily reliant on its exports of oil and gas, but the global decline in oil prices in the late 1990s hit Russia hard. With lower revenues from oil exports, the country struggled to meet its financial obligations. The Russian government had to keep the ruble pegged to the US dollar at an artificially high rate, despite mounting pressures on the economy. This created unsustainable economic conditions, leading to inflation and a currency crisis. There was also significant political instability in Russia during this period. Corruption, government mismanagement, and public distrust in leadership undermined efforts to stabilize the economy. In 1998, Prime Minister Viktor Chernomyrdin was replaced by Yevgeny Primakov, but these changes came too late to stem the crisis. The crisis unfolds. August 1998. By August 1998, the situation in Russia had become untenable. On August 17, 1998, the Russian government declared that it could no longer meet its debt obligations. It defaulted on its debt and announced a devaluation of the ruble. At the same time, the government froze bank accounts and suspended the conversion of rubles into foreign currencies. The financial markets reacted swiftly. Stock prices plummeted, the ruble lost over half its value against the dollar, and foreign investors fled the country. Russia's economy was now in freefall, and millions of citizens saw their savings wiped out almost overnight. The social and economic fallout. The collapse of the economy triggered widespread social and economic hardship. Banks collapsed, unemployment soared, and inflation surged. Prices of everyday goods, such as food and fuel, skyrocketed. In many regions of Russia, people had little to no access to cash, as ATMs ran out of money and credit systems failed. Public unrest spread, and protests against the government grew as the economic situation worsened. For ordinary Russians, the financial collapse was a devastating blow, and many saw their standard of living plummet dramatically. The country's middle class was essentially wiped out. International impact. The Russian financial crisis also had global repercussions. In the aftermath of the default, investors became wary of emerging markets, and global financial markets were shaken. The long-term capital management, LTCM, hedge fund, which had significant investments in Russia, was one of the most notable casualties. As Russian bonds collapsed, LTCM found itself facing huge losses and required a bailout from the Federal Reserve and other global banks to avoid a wider financial meltdown. Countries with heavy exposure to Russian debt, like Japan and Germany, also saw their economies affected. The crisis sent shockwaves through the global economy. The IMF and Russia's recovery plan. Despite the devastating blow to the economy, Russia didn't remain in crisis forever. The International Monetary Fund, IMF, and other international organizations played a key role in helping Russia recover. Russia's new leadership, under President Boris Yeltsin, implemented economic reforms aimed at stabilizing the country. The Russian government allowed the ruble to float freely, leading to further depreciation in the short term, but helping to reset the economy. Russia also renegotiated its debts and sought new investments, focusing on reforming its banking system and promoting economic diversification beyond oil and gas. Long-term effects on Russia's economy. In the years following the 1998 crisis, Russia began to recover, but it took time. By the early 2000s, the Russian economy saw significant growth, largely driven by rising oil prices and improved political stability. The crisis also pushed Russia to focus on improving its financial systems, adopting more market-oriented reforms, and increasing foreign reserves. However, the crisis left a lasting legacy on Russia's financial system and its people. Many Russians lost confidence in the banking system and the ruble, and economic inequality continued to be a challenge in the years that followed. Lessons learned from the 1998 crisis. So, what lessons can we learn from the Russian financial crisis of 1998? First, it's clear that relying too heavily on foreign debt, especially short-term debt, is a risky strategy. Second, countries that rely on a single commodity, like oil, must be prepared for fluctuations in global prices. Economic diversification is key to long-term stability. Finally, the crisis underscored the importance of strong financial institutions and good governance in managing a transition from a state-controlled to a market economy. The Russian crisis was a wake-up call for other emerging markets, showing just how quickly things can unravel when fundamental economic weaknesses are ignored. The Russian financial crisis of 1998 was a watershed moment in Russia's post-Soviet history. It exposed deep flaws in the country's economic system and set the stage for major reforms and restructuring. While Russia faced tremendous challenges during and after the crisis, it eventually emerged stronger, although the scars of the 1998 collapse are still felt today. What do you think about the Russian financial crisis? How did it shape the Russia we see today? Let us know in the comments below. If you enjoyed this video, be sure to like, subscribe, and hit the bell icon for more insights into financial history. Thanks for watching, and we'll see you in the next video.